There's going to be massive fiscal and maybe even some monetary stimuli down the road. And this is going to just, I think, delay and defray the recession for a little while longer. But as a caveat, it in no way eliminates the massive bubble that we have in stocks, bonds, and in real estate. So that hasn't gone away. It's getting worse and worse. But I do believe there's going to be enough tax cuts, and you're giving people no taxes on Social Security, no taxes on tips. Corporate taxes are going to 15%. So I think there'll be more growth and perhaps a lot of inflation. And what I'm most myopically focused on is the long end of the bond market. The long end of the bond market is not going to be happy when these things get passed. And if rates rise slowly and nominally in the context of a growing economy, then we could kick the recession down the road for maybe another year or two. If we get a little bit of growth and a lot more inflation and rates rise because there's problems in the credit markets, repo markets freeze up, and you can get a shock like we had over there in Britain. And that's a 1987 type of moment. I haven't been short the market since early 2023. I'm net long the market, enjoying a good part of this ride up. But I do have a cautionary tale to tell you. We are going to have a grand reconciliation of asset prices. Trump's election does nothing in the way of preventing that from happening. It's going to happen. And I believe the catalyst will be from the absolute skyrocketing of long duration bonds in our treasury complex. So you have several issues here. You have, first of all, illiquidity in the bond market now, inflation and insolvency. So illiquidity, the money that was in the reverse repo facility, which represented all those excess reserves that was dumped in by a central bank post-COVID. Those reserves were once $2.5 trillion. Now it's just like 150 billion. That's it. So your liquidity is leaving. The easy money that was used to buy treasury bills that was parked at the Fed earning interest has gone out of that fallow construct there, which is just, excess reserves parked at the Fed, outside of the economy, outside of the financial system, has already ex post left the Fed, has bought treasuries, has bought stocks, and it's still already there. And then you talk about insolvency. You're talking about a national debt that's going to be $60 trillion in the next 10 years. That's if we have no recession and no inflation in the next decade. The odds of that happening are zero. We are going to have an outbreak of inflation and or an outbreak of a recession, which is going to cause those, I would say, $2 trillion deficits to go to $4 to $6 trillion per annum. If I look at the interest payments that we're paying on our debt, 20 to 25% of all revenue in a healthy economy. Our debt is 720% of our revenue. And, inflation was, as they officially recorded it, 9% at the high. For decades, woe is me. We just can't get to 2% inflation. If only we can get to 2%. Well, you didn't get to 2, you got to 9, but really didn't get to 9. You really got to like 17 to 20. That's the reality behind it. And the worst part of it is that inflation is there. So when people who will asininely say, well, inflation's way down, and what they're really saying to you is, well, prices are way down. No, prices are rising more slowly. It's called the second derivative disinflation. So prices are rising more slowly from a level that most of the middle class, most of the country, the bottom 4 quintiles could not afford. The fact that they're rising at all is salt on the wound to them. So, a lot of these policies that Donald Trump, they are inflationary. Tariffs are a one-time hit to the cost of money. If you put 60% tariffs on everything that comes from China, have you ever gone Christmas shopping and flipped the boxes over and see where things are made? Everything's made in China, okay? So it'd be a one-time shock that comes on top of a massive COVID shock. And then you're going to have king of all debt and the king of a weak dollar. That's really deflationary, right? So inflation is a problem. It's going to get worse. And then you're going to get to a point where you have Powell's tenure ends in 2026. And you're going to have an appointed guy in there whose job is going to be to print unlimited amounts of money to buy long-term debt, so interest rates don't go through the roof. So create a lot of inflation to make sure interest rates don't go higher. That's an inflationary and interest rate death spiral. So if we want to become Zimbabwe, that's probably where we're headed. But for right now, the zeitgeist is we're going to have much lower taxes, much more growth, a little bit more inflation. You do not short a market that has more growth and higher inflation. There's a triumvirate of bubbles that I think are inexorably linked. So I think the first thing that's going to happen with my model is geared toward pickup is the bursting of the credit bubble. So you start seeing problems in the repo market and the money markets. That's where it all starts. And that filters into the stock market. And then you're going to see the housing market probably in a tertiary position. And then you have a problem because the top 20% of individuals in this country, they're responsible for all the consuming. This is why Donald Trump won. People don't want to understand. Donald Trump won, and he won even with minorities who normally don't vote for Republicans. This is what they never got, the liberals. Politics dictate fiscal and monetary policies, and that's what drives the economy. I mean, we don't have a free market economy here. We're not looking for what's the supply of savings versus the demand for money? That's not what we're looking at. We're looking at an artificial supply of money, and we're looking for how much demand comes from the largesse given by government. Powell is cutting interest rates, and he said he's going to cut them again because he can't predict what the Trump administration will do because nothing's been done yet. I mean, he can't say, oh, we're going to deport millions of illegal immigrants and that could drive up the cost of labor. He can't say that 60% tariffs on China, and I think it's 10% for everybody else, that might drive up prices on a one-time step-up basis. He can't say that cutting taxes across the board and corporations and individuals could drive up the deficit short term. But reasonable people can assume. Now, I'm all for tax cuts, but I'm for spending cuts. Where's the talk about cutting? If you don't cut Social Security, you don't cut Medicare, Medicaid, and you don't cut interest on the debt, what have you done? Everything else is just ancillary. It's marginalized. If you don't attack Social Security, Medicare and Medicaid, interest on the debt, and defense, that's almost all of the budget. I am for shrinking the size of government. So if you cut taxes and you accompany that with spending cuts, that would be a panacea for me. It would be wonderful news. But if you're going to increase the debt and deficits at this juncture, we are set up for a massive revolt in the long end of the Treasury complex, which would directly affect home prices. It would directly affect the price of stocks. Gold likes it when nominal and real interest rates are falling and there's less competition for stocks. So think about a recession. Gold, the best sector, I have a 5-sector portfolio. The best sectors are sectors 1 and 2. So that's disinflation and deflation. So if you think about fears of recession, fears of chaos in DC, gold was thriving up until the election. If I think a recession is coming, and I think chaos is going to occur in our political environment, then earnings would be going down. So stocks would not be a good alternative. And nominal rates are falling. And that's less competition for gold, which is money, which competes with money markets. And I'd rather own gold than lose money in stocks. That was the calculation heading into the election. Now with the election of Donald Trump, what's happened to interest rates? Actually, not only since Trump has been elected, but what happened to interest rates since Powell cut interest rates in September? Interest rates on the long end of the yield curve are flying higher. So that's more competition, even short-term rate. Even look at a 2-year note. Rates are rising across the yield curve. Now, I know the Fed funds rate is going down slowly. I don't think Powell's going to be able to cut this rate to 2.5%, 3% very quickly, like what I thought was going to happen if Kamala Harris was elected. You have to react to these changes. So calculation from gold is, I've elected a president who's more pro-growth, more pro-inflation. Interest rates are rising. There's more competition for gold, which is an asset that doesn't bear any interest. And by the way, earnings could be better too. So let's buy some stocks. And you throw onto that poop pile the fact that the president, for some strange reason, loves shitcoin. He loves cryptocurrencies. Instead of tying the nation's currency to gold, as Article 1, Section 10 of the Constitution says, he loves Bitcoin. So he loves Bitcoin. Bitcoin is flying, which is, some people think is competition for gold. So people are going to Bitcoin. And what has the dollar done since the election? Because we have more growth supposedly in the pipeline. The dollar has risen. So you have a higher dollar, higher interest rates, more competition for Bitcoin, higher growth, higher inflation. All those things are deadly for gold. And that is why I sold my position down to about 4 or 5% in the portfolio, and it could go down even lower. However, longer term, what's going to happen is the dollar is going to crash, and we're going to have a central bank that's forced to monetize trillions of dollars in treasury debt, like they've done before. And that means nominal rates will be lower than normally would be, and real interest rates will be falling. And that is when you want to buy gold, most of all, is when real interest rates are falling, confidence in the currency and confidence in the government's solvency is in question. It's exactly what's going to happen. So do we have a short-term problem for gold here? Yes, it could last several months, several quarters even. But I will pick up on it when things change. Right now, gold is not my favorite play, and silver is not either. But they will be mandatory investments down the road once again. If you want to make money in this environment, I would myopically focus on the functionality of the credit markets, unless and until you see some disruption there. Or as of right now, the answer is no. Financial conditions are easy and credit spreads are as tight as they've ever been. That's your danger sign. But until that changes, until those spreads blow out and conditions tighten, I would say just, stay long the stock market. But I will tell you, the proliferation of target date funds and passive closet indexed fund investing has exploded in the last few decades. The ownership of stocks for Americans has never been higher. And everybody is concentrated in the same thing, the same index, which is dominated by 7 stocks.
Right.
When that changes, I've been doing this 34 years, so I can tell you, I can guarantee you, it will change. There's going to be implosion in asset prices like we've never seen before. And the ramifications of that are, there's going to be helicopter money and QE infinity, and the balance sheet of the Fed's going to go to $20 trillion. It's going to be a disaster for the stagflationary outcome of this country. But the Trump's election does delay that process. It doesn't cancel it.